6 months ago, Daniel walked into a bank asking about a car loan. The number on his credit report, 608. The loan officer didn't even finish reading his application before quoting him a 16.9% interest. On a $22,000 car, that's nearly $10,000 in extra interest over 5 years for the exact same vehicle, the exact same person. Daniel asked one question on his way out. What would it take to get a better rate? The officer handed him a pamphlet about building credit over time and wished him luck. 90 days later, Daniel came back. Score 749. Same income, same job, same everything, except one thing he'd learned that the bank never mentioned, never advertised, and had zero reason to ever tell him. That one thing saved him over $8,000, and it took him about 15 minutes to set up.
Here's what nobody tells you about credit scores. The standard advice is always the same. Pay on time, don't overspend, be patient. Wait 2 years, wait 5 years, let your history age. That advice isn't wrong, it's just designed to keep you waiting. Every month you sit in the fair or good credit range instead of excellent, you're paying a tax. Higher rates on car loans, worse terms on mortgages, bigger deposits on apartments. Even your car insurance costs more in most states. The average American with a 670 score pays roughly $200,000 more in interest over their lifetime compared to someone with a 780. Same country, same economy, different knowledge. Banks know this gap exists. They profit from it. A customer stuck at 670 generates more interest revenue than one at 780. So when you walk in asking how to improve your score, the advice they give you is technically accurate and conveniently slow. What they don't tell you is that the credit scoring system has built-in mechanics that can move your score dramatically faster. Not tricks, not loopholes, legitimate features that exist inside the official rules that just happen to never come up in the pamphlet they hand you at the door. The mechanism is called an authorized user trade line. Here's how it works. Every credit score is partly calculated based on the age of your accounts. How old is your oldest card? What's the average age across everything you have open? Older history signals stability. Stability signals low risk. Low risk means better scores. Most people assume account age is just time. You opened your first card at 22, you're now 28, so you have 6 years of history. Nothing you can do about it, just wait. That assumption is exactly where the opportunity is. When someone adds you as an authorized user on their credit card, that account's entire history transfers to your credit report. The age, the payment record, the available limit, all of it, immediately, not over time, immediately. So if your older sister has a credit card she opened in 2009, perfect payment history, low balance, high limit, and she adds you as an authorized user today, your credit report suddenly shows a 16-year-old account with spotless history. Your average account age jumps overnight, your available credit increases, your score follows. This is what Daniel did. His uncle had 2 cards dating back to 2004, combined limits over $40,000, never missed a payment. He added Daniel as an authorized user on both, never handed him a single card, never gave him access to spend $1. Within 45 days, Daniel's report looked completely different. Thin file turned established, short history turned long, score jumped 141 points. The bank knew this was possible the entire time. The strategy works, but the details determine whether it works well or backfires. First, the account you're added to has to be clean. Perfect payment history. No late payments, ever. Utilization under 10% ideally. The older the account, the bigger the impact. If the account has any missed payments in its history, those negatives transfer to your report, alongside the positives. Vet carefully before you ask. Second, this works best with family. A parent, grandparent, older sibling, or close relative with long credit history is the ideal partner. They don't need to give you a physical card. Most people execute this strategy without the authorized user ever touching the account. It's a credit-building move, not a spending arrangement. Third, check which banks actually report authorized users. Not all of them do. Chase, American Express, Bank of America, Capital One, and Discover all report authorized user accounts to the major bureaus. Smaller regional banks sometimes don't. Confirm before executing. Fourth, the timeline is faster than you think. Changes typically appear on your credit report within 1 to 2 billing cycles after being added. Not months, not years, roughly 30 to 60 days. Fifth, it's completely reversible. If anything changes, the relationship, the circumstances, anything, the primary account holder can remove you at any time. The account eventually drops off your report. Zero permanent risk to either party. One conversation with the right person, 15 minutes online to set it up, 30 to 60 days to see the result. That's the entire process. Authorized users are the biggest lever, but there are 2 more mechanics worth knowing. The utilization timing trick. Your credit utilization, how much of your available credit you're using, makes up roughly 30% of your score. Conventional advice says keep it under 30%. Better advice says under 10%. But here's what most people miss entirely. The balance reported to credit bureaus isn't your balance on the due date, it's your balance on the statement closing date. Those are 2 different days. You could pay your card in full every single month and still show 60% utilization if your balance is high when the statement closes. The bureaus don't know you're about to pay it. They only see the snapshot. Fix: pay your balance down before the statement closes. Not before the due date, before the closing date. Do that consistently and your reported utilization drops to near zero. Score improvement shows up within a single billing cycle. The credit limit increase move. Utilization is a ratio. You can improve it 2 ways: spend less or increase your limit. Most major issuers allow you to request a credit limit increase with no hard inquiry on your report. American Express, Chase, and Capital One all have options to request increases directly through their app. Soft pull only, no score impact. Request increases every 6 to 12 months across all your cards. Over 2 or 3 years, your total available credit can multiply significantly, which pulls your utilization ratio down even when your spending stays exactly the same. Lower utilization, better score, no extra effort. These 2 moves combined with the authorized user strategy cover roughly 75% of what actually moves a credit score. Everything else is maintenance. Most people hear about these strategies and immediately undermine them. Here's where it goes wrong. Picking the wrong account. This is the most common mistake. Someone gets excited, asks a relative to add them, and never checks the account's actual history. One missed payment from 3 years ago, utilization sitting at 45%. Suddenly, your report gets worse, not better. Before you ask anyone, pull their account details. Verify the history is clean. Verify the balance is low. Opening new credit at the same time. Every new credit application creates a hard inquiry. Each one drops your score 5 to 10 points temporarily. Opening a new account also lowers your average account age, the exact thing you're trying to improve. People execute the authorized user strategy perfectly, then immediately apply for a new store card and cancel out half the gain. Pick one direction and stay in it. Inconsistent payment timing. Paying before your statement closing date works, but only if you do it every single month without exception. 1 month of high reported utilization can erase 2 or 3 months of careful optimization. Set a recurring calendar reminder 5 days before each statement closes. Make it automatic so it doesn't depend on memory. Quitting too early. Changes take 1 to 2 full billing cycles to appear on your report. That's 30 to 60 days minimum. Most people check their score after 2 weeks, see nothing, and assume it didn't work. Then they abandon the strategy right before the update hits. Set a reminder for 60 days out.
Pull your report then, not before. The strategies are simple, the execution is simple. The only thing that breaks them is impatience and incomplete information going in. Here's exactly what to do based on where you are right now. If your score is below 650, start with the authorized user strategy. That's your biggest lever. Identify 1 or 2 family members with accounts older than 10 years, clean payment history, and low balances. Have the conversation. Get added. While you wait for that to hit your report, pay down any existing balances before your next statement closes. If your score is between 650 and 720, you're close. Small moves create big jumps at this range. Request credit limit increases on every card you currently hold. Adjust your payment timing to reduce reported utilization. If your account history is thin or short, the authorized user strategy still applies and still moves the needle significantly. If your score is above 720, you're in good shape but not finished. The difference between 725 and 775 can mean a quarter-point difference on a mortgage rate, which translates to tens of thousands of dollars over 30 years. Focus on utilization timing, periodic limit increases, and protecting the history you've already built. Regardless of where you start, pull your credit reports from all 3 bureaus today. Not a score, the actual reports. Errors show up more often than most people expect, and a single inaccurate account can be suppressing your score right now without you knowing. Disputing real errors costs nothing, takes an afternoon, and sometimes moves the score more than any strategy will. Daniel didn't find a loophole. He didn't game the system or exploit a glitch. He simply learned how the rules actually worked instead of the simplified version banks hand out at the front desk. The credit scoring system was built by lenders for lenders. It was never designed to help you optimize your financial life, but the mechanics inside it are knowable. And once you know them, the gap between where you are and where you could be closes faster than anyone in that industry wants you to believe. That gap is money, real money, compounding over decades. Now you know where it is.